Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, all right, here's a little trick, folks. If you want to have the most read story on the Bloomberg terminal, this is what you write. Bonuses set to grow across Wall Street for first time since 2021. Every single Bloomberg user out there on the planet clicked on that story.
It's catnip for readers, really.
It is awesome. It is great stuff. Katherine Doherty, she's responsible for this one. She's a finance reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. So we're going to get bonus increases this year for our friends on Wall Street?
Seems like everyone is going to be going out of 2024 with a smile on their face, hopefully.
Nice.
Ooh, yeah.
So I guess it's just simply a function of profitability on the street. I mean, just huge profits you see coming out of these big investment banks.
So it shouldn't come as a surprise because we've seen the banks report more activity across trading. Even deals are starting to show signs of a return to more M&A. It just means more fees. And so when there's more revenue coming into these banks, they're able to pay their bankers more. And so across Wall Street, we're likely to see double-digit pay increases. Nice. Some as much as 25 to 35%, others closer to 10%. But it does look like this is going to be a bigger bump close to the 2021 highs. So it's been 3 years, but we're starting to see a turnaround.
Talk to us about corporate clients specifically returning to the market, because I know obviously the Federal Reserve and previously in those 3-year span where rates were the highest they had been in about a generation, kind of the difference there when you're beginning to see that ease now when it comes to borrowing costs.
Yeah, so we see a return to companies tapping both the equity and debt markets. Debt, especially as rates are coming down. And this is also a reflection of just we had a period of uncertainty, and now that there's more clarity on what the Fed is going to do with rates, now that we have gotten through the election and we know who the new administration is going to be, that is probably going to just mean more deal activity and more companies that are tapping their bankers and asking what they might be able to do to increase their earnings or to help with their balance sheets if they have been stressed over the past few months or years.
Back in my day on Wall Street, my bonus would make up many years 95, 96% of my total annual compensation came from my bonus.
Wow.
But what's happened now is they've increased the base pay and reduced the amount of incentive compensation.
Okay.
To kind of, get away from those big bonus numbers. But
what was the big catalyst to shift that?
I think it was just some of the public backlash to the big bonus numbers out there. So it created the exact wrong incentive, in my opinion. But anyway, debt underwriting, equity underwriting, they're going to be the big winners, right?
Yes. It seems like that's where we've seen a lot of the activity. Right behind them, trading and M&A, it's returning. So that wasn't the strongest sector in the past, especially the last 2 years. But 2024 is looking up. Those green shoots are starting to actually show some activity. And looking ahead, we've even got some indicators for 2025. I know it seems far away, but it's really not. It's right around the corner. And all indicators are pointing to positive growth in the new year as well as to end this year.
Were there any sectors that were left out?
Well, retail and commercial banking, I don't know what you mean by left out, but those are actually the only two that are projected to be flat or even slightly down. So not catastrophic, but not the payout and the boon that you might see with debt and equity underwriting bankers.
And is it expected that'll be pretty much across most firms be pretty similar? Do you think we're going to have some firms that are going to do really better in terms of paying people versus some that are going to be laggards? I know some firms have some pressure from their shareholders to keep that expense ratio in line and things like that.
That's right. But I would say that across the big 6 Wall Street banks, they remain competitive. So they have to pay their people so that they don't, if you are thinking about your expenses, and they need to be, but if you skimp and you're not paying your people what they expect to be paid, they might go across the street. And then we'll start to see some jumping, which we saw during 2021, and that has pulled back just with compensation. So competition was not as much of a problem for the banks, but it's a really great point. It's something that we'll pay attention to. Will this mean that there'll be more shifting of the chairs, we say, across Wall Street firms?
And we'll talk, at 2 p.m. Wall Street today, Shonali Basak interviewing Jane Fraser, CEO of Citi.
Tune in.
So that'll be some good conversation about the state of global Wall Street. The average salary, including bonuses, was $471,370 last year, down 5.2%, largely due to smaller annual payouts. That's what the New York State Comptroller Thomas DiNapoli said last month. So the folks who really pay attention to how much Wall Street's getting paid is the city of New York to get their taxes. So.
Whenever you're speaking with your sources, what's their thoughts on a market volatility when you have a new administration coming in, and what this could potentially shape when you're thinking about how bonuses could potentially change next year?
So I think what was interesting in talking to folks leading up to the election, many bankers that I talked to said that this was not a decision, or trading firms, investment managers, they weren't making the decision of where to move their money the week of the election. That decision had been made over the summer or weeks, even months before. So we saw a lot of activity, which will likely be reflected in the next earnings cycle for banks when they report how much of their trading activity, which we expect to be up. And now that the administration you even see some of the folks that are being picked to lead in the Trump administration. As that becomes more clear, you'll see probably people taking even more bets on where the economy is headed, maybe some geopolitical tensions that people will start to make decisions based on the new leaders that are in place. So you can expect to probably see even more trading activity. This is not the end. It's probably just the beginning, or the way that I see it, and from the conversations that I'm having with traders on Wall Street.
Catherine, thank you so much for joining us. Really appreciate it. Excellent reporting. Most read story on the Bloomberg terminal. How about that, Katherine Doherty? Of course, I could have written it and become the most read terminal. But that's how you write it. You write anything about Wall Street and bonuses.
Boom.
Boom.
There you go.
Katherine Doherty, finance reporter, Bloomberg News, joining us here in our Bloomberg Interactive Brokers studio. So, again, our friends on Wall Street, looks like they're going to have a pretty good year this year. Maybe that means they'll be buying more terminals, leasing more terminals. That's how I think about it for the Bloomberg.
Connecting it back.
Connecting it all back to us.
Full circle there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Home Depot put out some numbers. Apparently some of the hurricanes have caused people to have to get a bunch of supplies to repair their homes, and that kind of that worked out well for the folks at Home Depot. Drew Redding, home builder analysis for Bloomberg Intelligence, joins us here. Drew, talk to us about Home Depot, I guess, raising its outlook here. What did you hear from the company?
Yeah, solid quarter, a beat and raise on same-store sales, which is the key metric everybody pays attention to. It looks like they got a little bit of benefit from warmer weather across the country. And at the same time, they also benefited from some of the recent hurricane activity that we had in the South. They mentioned about a $200 million sales benefit, or 55 basis point impact to same-store sales. But I think that the main takeaway is that the underlying trends of the business really haven't changed all that much, despite the raise to the full year guidance, which really just reflects the outperformance this quarter due to weather. Their customers are still battling with the cumulative impact of inflation over the last several years. One thing they continue to call out is general economic uncertainty. And you also have the housing market, which is extremely depressed. If you look at resale volumes in the existing home market, we're at the lowest levels in 14 years. So, it's hard to get a turnaround in the home improvement retailers until we start to see a little bit more activity on the housing front.
And we're also going to have Lowe's earnings next week, as you know. It's interesting, just looking at Home Depot stock, ticker symbol HD, it's down about 0.5% right now. It's actually up 17% year to date, but it's still underperforming Lowe's. That's actually up about 22%. Why the divergence here? Because we do know there's some differences between both companies.
Yeah, I think the primary reason for the outperformance just has to do with kind of a technical situation where Home Depot's valuation premium over Lowe's kind of got a little stretched versus history. So part of that was just playing catch up. Lowe's is also viewed as more of a turnaround story than Home Depot. So they're doing some company-specific things on the margin side, on the cost takeout side, that are kind of lifting their margins up to where Home Depot's are. So I think part of it is just where the multiples were between the two companies, and part of it is investors placing their bets on a turnaround story with Lowe's.
And just remind us the differing customer bases, Lowe's versus Home Depot. Is one more professional than the other?
Sure. So Home Depot is about 50% DIY, 50% professional contractor. Lowe's is about 75% DIY, 25% pro customer. That mix has really been a benefit to Home Depot because, as we know, the professional contractor has held up relatively stronger than the DIY market. They're still operating backlogs over the last several months, so they continue to have that stream of business. Now, it's certainly, we're not seeing those big ticket projects being replenished at the rate they were over the last couple of years, but they're still working with pretty strong backlogs. Home Depot has made a point of emphasis to go after an untapped market within the broader professional contractor space, and that's really in the market for larger, complex projects. They peg it at about $200 billion, and it's really what they want to do is become a one-stop shop for contractors who have historically gone to multiple suppliers for their products. They want to bring all that in-house and offer all the capabilities to those contractors that they're getting at the independent level.
We only have about a minute left, but I was curious, if you're on the earnings call for them, what would you want to ask their C-suite executives?
So it actually just wrapped up, and I think the biggest takeaway is really, what we need to see on the existing home sales front in order to see a broader rebound in the home improvement space. And it's not just the impact rates are having on housing turnover, but it's the impact that rates are having on big ticket discretionary products. So really the color that they provided in terms of what they need to see on rates in order to unlock that big ticket discretionary category is what I think a lot of people are paying attention to. And until, we see something probably in the 6% range, we don't think you start to unlock sales or that tappable home equity that's built up over the last couple of years.
Yeah, mortgage rates are going the wrong way. Mortgage Bankers Association 30-year fixed rate 6.81%. That's the highest it's been since kind of back in the summer. So no bueno if you're looking to refinance a mortgage there. Drew Redding, Homebuilding Analyst for Bloomberg Intelligence, joining us from Princeton.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bitcoin earlier in this session was pushing up $90,000 per token. We're now at just under $87,000 per token, but weren't we just at like 60,000 a week ago or something?
So in the last 10 sessions, it's rallied 27% through yesterday's close. So there you go.
All right, I'm blaming Miami Beach for that. Mike McGlone, Senior Commodity Strategist for Bloomberg Intelligence. He's down there in Miami. Mike, is this a trading technical thing? Is it overdone? What do you make of Bitcoin these days?
I think the best answer is yes. There's a lot of that going on. The key thing is Fed is ETF flows. Right now, Bitcoin, just as of yesterday, just crossed the threshold of 100 billion in total ETF holdings. To put that in context, a year ago it was about 8 billion. So the launch of US ETFs has brought into the mainstream, has really kicked it in. And also to put that into context, total holdings of gold ETFs are around 230 billion. So Bitcoin's almost halfway there, and it's only been less than a year of actual physical ETFs. So there's a lot of physical buying. We all know about the diminishing supply, and right now it's a bit of animal spirits. What I'm concerned about is you look at the correlation of Bitcoin, the S&P 500, the 60 days, it's the most ever on the way up. So the fastest horse in the race is leading everything up. And remember, the world changed a week ago when President Donald Trump was elected. Remember, in first Donald Trump's administration was really pushing against crypto. It was bad for the dollar. Now he completely flipped, and he's making the Bitcoin and the crypto people very happy.
So Bitcoin has been trading more like a leveraged version of beta than a digital version of gold. I know that's what you were writing about too. What do you think this could tell us also maybe more broadly about U.S. equities when you have a big run like this in the crypto space?
Well, it's catching up. So it pumped early in the year when the U.S. ETFs were launched. It pumped up to around 63 or 73, and then went back down to 50. And now with this paradigm shift of the new administration be completely favorable, probably going to get rid of the old SEC chairman, Gary Gensler, and have one that's more favorable. So it really shifted the narrative in this space towards positive inklings and positive regulation. So we have those animal spirits going. The question is how much further. And I'm glad you mentioned that, because I look at Bitcoin as it basically trades 3 times the volatility of gold and S&P 500. Now, 5 years ago, it traded almost 9 times the volatility. So its volatility is declining, but right now it's in that stage that, oh boy, we have a complete flip over. The administration's positive. We're seeing massive buying. Everybody's looking at 100,000 as the next key resistance. A lot of people are saying by inauguration. I don't really know for sure if it's going to get there. But the key thing I want to point out is that what I could say is Bitcoin will do fine as long as the stock market goes up. We have not seen a big test yet of stock market going down and Bitcoin going up. And it's a much higher volatility. So there's a tendency to be a leading indicator. And again, it trades 24/7. So during the, even this weekend, a lot of times last weekend, it pumped up almost 10% on just over the weekend.
Who's the marginal buyer of Bitcoin here, Mike? Do we think it's just the retail investor via his or her ETF?
Right now it is. It's that allocation of capital, Paulie. People are telling me, oh, you just got to get off zero. And by getting off zero, maybe 1 to 2%, and that's what's happening on a pretty significant scale. And people look at it as, okay, if I can hold 100 units of, say, the NASDAQ or S&P 500 and put in maybe 1 unit of the Bitcoin, I can actually have the same type of upward trajectory with less risk. I can sell more of those higher, the lower volatility assets and buy this, rapidly advancing speculative digital asset. But the risk is it still is very much of a speculative digital asset. Just right now, we're only a week away from this paradigm shift of President Trump's decisive election. And I was delighted to see him switch back over to favorable cryptos, because I like to point out is, on a one-day basis right now, a 24-hour basis, the number one trade of crypto is not Bitcoin, it's actually Tether, and that's the US dollar. So our regulators and our leaders are figuring that out. It's good to see that.
What do the technicals tell us about Bitcoin? What's resistance, what's support at this point?
Yeah, everybody's looking at 100 grand as kind of the key level. The key support is 70. That's kind of where it broke out from. So 70 to 100 are the key levels. And we all know it's Bitcoin. It can be quite, can make you lose your hair, as people on the viewers can see. I did that. But yeah, so 70 to 100,000 are the key levels. After that, we'll have to see.
All right, for Alex Steele, I know she's listening. Talk to us about oil. We're down, got WTI crude oil down here at $68 a barrel. Is that just expectation that we're going to drill?
I'll see at 56. It's just a matter of time. 56 is the average cost of production in the U.S. based from BNF, Bloomberg New Energy Finance. And every day that goes by, we stay above that level. You see rapidly increasing excesses of supply in the U.S. and Canada, decreasing demand in China, most notably in diesel. Diesel demand is declining in the U.S., in Europe, in India, China, and we see that it's the growing spare capacity out of OPEC. So crude oil, I think, is going to do what natural gas did. It had to get below its cost of production. It did that in Q1, and it's bounced. The grains have basically done it in just a matter of time. And what's happening with the potential for tariffs is you see the headlines in the terminal that China's potentially enemy number one for Trump 2.0. This is really bad for that number one demand force for commodities in the planet, which means we should do what's normal in commodities, get below that cost of production. That's why I point out typically it's below 56 for WTI, and then I think it's put a pretty good ceiling just below 80. And the question is, what stops that? I don't know right now.
Switching gears and looking at precious metals, I know gold, you were pointing out, may actually have a foundation from a technical perspective around 2,400 an ounce, on track toward 3,000. Talk us more about that.
So I like to reiterate what I've been saying for, I hate to say how long, a couple of years. It's a matter of time it gets to 3,000. The high this year is around 2,800. That was very expensive. It's just pulling back for good reason, the decisive election, the potential détente in global geopolitical risks, which is probably not going to happen. But the bottom line for gold is this is a bull market. It's bucking. It's backing up a little. The difference is we haven't seen that in the stock market in a while. They've been kind of going up tick for tick. On a one-year basis, gold's up about 33%, S&P 500's about 37%. So it's just a question of what will drive it next. The bottom line is we have rising geopolitical tensions, and the number one source of demand for gold has been central banks. ETFs are just starting to turn upward, but what I've been saying about gold is there's really not a reason for U.S. investors to buy it until we see that U.S. stock market tear and or rates to go down. But for now, maybe it gets down to 2,400. That would be a decent backup, normal backup in a bull market. Otherwise, it's still a bull market. It's just bucking a little.
Mike McGlone, great stuff as always. We'll talk pork bellies next time. Mike McGlone, senior commodity strategist for Bloomberg Intelligence. He's down there in Miami. I don't know how he got in Miami, but he's there.
He's a pretty sweet deal.
He's got a sweet deal. But you get to be Mike McGlone. You can do kind of
right.
whatever you want. He said, "Hey, I'm going to Miami." I said, "Okay, enjoy it. Have fun."
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. That's the internet. So head over to youtube.com, search Bloomberg Podcast, and that's where you'll find us. Do you believe that they allow people to manage money in Santa Fe?
I believe that.
Mexico? Can you believe that?
Hey, they let us do it in Texas, so why not?
Emily Leville, she joins us. She's a portfolio manager. Thornburg Investment Management. They are based in Santa Fe, New Mexico. It's a thing. I confirmed it. It's really the case. They got a lot of money, $46 billion in client assets based in Santa Fe. Emily, you look at international growth.
Correct.
Okay. Is China, it's international, but is there growth? How do you guys think about China?
So, thanks for having me. We invest in companies, not countries.
Okay.
We're a concentrated portfolio. Most of the portfolios at Thornburg are. And, we do deep fundamental analysis on all the companies that we have in the portfolio. So I think that there are selective, really interesting opportunities in China. We have been staying away for the last couple of years on policy uncertainty, on growth concerns. As you mentioned, growth has been, by and large, GDP growth has been very weak in China. You've had price deflation. But, we see early signs from some of the stimulus measures announced from September through the end of October that the Chinese government is really focused on bringing growth back to the economy. They see it as a priority, obviously. And we do think, therefore, that there are selective places to invest there. And we think it's really important for the global economy. I mean, it's the second largest economy in the world. 20% of Apple revenues are there.
Yep.
So we do see opportunity. And look, when you're priced at, sub 10 times earnings, it doesn't take much. Expectations are very low. And so we want to be very mindful of that.
I want to talk to you about positioning in particular in the U.S. just because Bank of America, as you know, they put out their fund manager survey this morning. And each month they always have interesting statistics in there. And so something that really jumped out was that U.S. equity positioning had actually surged to an 11-year high on the back of Trump winning the U.S. presidential race. And I was curious, where are you seeing particular points in the equity market that look stretched, whether it's an index level or a sector level? And how are you talking to your clients about that?
Well, we're international investors, so we're going to be biased to begin with. But look, we've been saying this for a number of years. I think it continues to be true. U.S. equity markets are stretched, and after the recent move we saw last week, look, very little about the fundamentals has actually changed. You might get some deregulation. That could be a boost to earnings growth in certain sectors of the U.S. economy. But there are other policies that the Trump administration is putting forward which are inflationary, they're contractionary. And so I'm not convinced that move higher is going to be sort of fulfilled with greater EPS growth in the next couple of years. So when we look outside the U.S., we find really interesting opportunities to invest in businesses that are exposed to the same sort of structural growth trends of the companies that you see here in the U.S., but they typically trade at a lower valuation.
And something else I'm curious about is emerging markets, because some of them are more commodity driven than others. So which ones do you see positioned more well in 2025?
Again, companies, not countries for us. Positioning into 2025, we're really focused again on these long-term structural winners. Latin America, for example, we've got, I call it the dynamic duo, Mercado Libre and Nubank, because, you've got Mag 7 here, and we talk about the Fantastic Five in Europe as well. But look, these are businesses that are going to win regardless of the environment. I invested in emerging markets for a good part of my career, and you just have to be focused on the companies because the macro is so volatile. You've got to be able to find companies that are in control of their own destiny.
Shopify having a ripping day today.
Indeed.
52-week
we love
high,
it.
up 25%. You guys own it. Why do you own it?
So Shopify is a perfect example of what I was just talking about. A company that is in control of its own destiny. This is a consumer-focused company. The majority of its business in the U.S., but a growing presence outside the U.S. as well. Obviously, a Canadian-based business. Shopify has been taking share from sleepy incumbents, Magentos, Salesforce, big software providers that where e-commerce was, or e-commerce services were just a small portion of what they offered. Shopify has been laser focused on that. They've been taking share with better product rollouts. They've been moving up market. They used to be really focused on this SMB segment. Now they're moving into enterprise and they're winning. So, we saw top line growth was 26%. The market was looking for 20. Free cash flow margins of 19%. So they're achieving this balance of continued growth and share gains and profitability. And that's exactly what we want to see. And we believe that a business like Shopify, because they have this better value proposition, is going to continue to grow and take share regardless of the consumer environment.
Talk to us about those Chinese internet giants that you're looking at more selectively, and then how in turn that could end up impacting more of those international consumer type names.
So the Chinese internet companies are really interesting. I mean, look, if you look at companies like Menton, which is a food delivery business in China, Menton has actually been growing earnings throughout the last 2 years and really delivering on a promise to balance growth and profitability. And so, on a fundamental basis, and again, as fundamental investors, we believe that's really what's going to drive stocks in the long term is can you grow your earnings? Can you grow your EPS? And can you generate a return above your cost of capital? And we see with a business like Meituan that they have been able to deliver that. Other companies, JD, Baba, there's been a bloodbath of competition in China over the last few years. We are looking for early stages of how that might shake out. If these companies are going to try to focus on their lanes and focus on that growth plus profitability. I really think what's going to drive an improvement for JD and Baba is going to be the macro dynamics. I mean, Baba more specifically has a number of assets that they can divest and monetize as well, which could be very impactful for total shareholder return. But that's a very China-specific part of the business. Now, the company in China that's really moved away from China specifically is PDD, which owns Temu, which many of us as U.S. consumers know. And again, that is just an incredible value proposition for customers.
All right, Jess, you could fill an ocean with what I don't know. I don't know anything about Nubank, and it's got a $75 billion market cap. How did I miss this? It's up 90% year to date. What is Nubank, and why do you guys own it?
So Nubank is a digital bank started in Brazil by a Colombian.
I use my app, my Wells Fargo app.
Yeah.
You should check out the Nubank app. No, I mean, Nubank is an incredible business. Here's what Nubank's competitive advantage is. They are the low-cost supplier of financial services.
Okay.
Starting in Brazil, in Mexico, in Colombia, and they have taken tremendous share because they are offering a better value proposition to customers at a lower price. They've managed to maintain good asset quality as they've done this, which is always the Achilles heel of a bank, right? It's all well and good. You can attract customers, et cetera. You blow yourself up on lending. They've got a number of executives that are ex-Capital One executives, so really focus their early products on credit card and just offering great value for the consumer. Just to give you a sense, they've got over 100 million clients in Latin America now. In Mexico, where they're just starting to grow their lending products, half of Mexicans don't even have a bank account. 85% of them don't have a credit card. This is a classic market that has been underserved by sleepy incumbents. A low-cost supplier comes in and says, you know what? We're going to disrupt this with a better product that customers are going to love. And they are maniacally focused on their customer experience and product development. And I think it's a tremendous business. I think it's a tremendous business that has runway to compete in a number of different markets outside of just Latin America in the long run.
I have to ask you about chip stocks and how
Yes.
you're positioned there, because I mean, we know that's been such much fervor over the last year.
There's been a little bit of a fervor and then a little bit of a retracement in the last couple of quarters. We remain invested. We're long-term investors. Look, we think, AI is a platform shift that is potentially one of the more impactful ones that we've seen over the last 40 years, really since we moved from mainframe to PC. And the scale and the implications of it are, I think, still underestimated by the market. The way that we are invested in this space is still through the picks and shovels. It's the semiconductor industry. And the reason for that is that we still don't have a clear picture of what the AI applications are going to be on the top there. It's tough to invest as a public market investor in that space anyways. We also see, incredible benefits of scale in this industry. So the big are going to get bigger. So your semiconductor manufacturers, designers, the cloud service providers that are actually buying the GPUs. And the two interesting points that I think are continue to warrant staying invested is that you continue to see CapEx growth, but it's sustainable, right? This is all self-funded by the cloud service providers. This is not like the 2000s where you've got, companies that are spending 2 to 3 times their operating cash flow. This is, well in line with their historical spend, and utilization levels are 99%. And so, they're getting a return on this investment. So that's really where we see, and outside of the US, this is a global value chain, TSMC, ASML, Disco, AMD, obviously in the US, but this is really where the best quality businesses, the winners globally, are actually, a lot of them are outside the US.
Interesting. Emily, thank you so much for joining us. As always, Emily Leville, she's a portfolio manager. One of the smarter people, young people that we speak to. I'm just blown away every time. Portfolio manager, Thornburg Investment Management, somehow ensconced in Santa Fe, New Mexico. I don't know why she's not riding the subways here in Manhattan like with the rest of us down in the subways.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess Menton sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Here's the mistake I make when thinking about commercial real estate. I just think about offices, and that's just such a small
I know how big
part
you are
of it.
about, especially people coming back in office.
Yeah,
too.
I don't know, but there's lots of opportunities. There's risks out there. Our next guest is going to walk us through it. Robin Potts joins us here. She's CIO, Canyon Partners Real Estate, based in Los Angeles, but she's here in the world's financial capital. Why wouldn't you be? I mean, this is where it all happens. Let's be honest. Robin, thank you for joining us in our studio here. Okay, for simpletons like me, I think about commercial real estate. Let's just get that. When I think about commercial real estate, I just think about office. Let's just get that out of the way first. Office space in LA, in San Francisco, in New York, in Boston. Any hope for office space?
Office space on the West Coast, like you just mentioned, is in a world of hurt.
Yeah.
LA and San Francisco are approaching 30% vacancies, which is extraordinary. And when you look forward, to get to that equilibrium between supply and demand is going to take years. But you do have bright spots within each of these markets, depending on the class of office that you're in. So, the flight to quality theme that you've seen from tenants preferring newer build office space versus the older space that's becoming obsolete is a real trend.
So talk to us more about that newer space. What kind of particular industries are jumping into that?
It depends on which city you live in and which industries kind of underlie that
Right.
fundamental city. So obviously, in San Francisco, you've seen a lot of news about AI really jumping in to take leasing and absorption. In LA, we're still dealing with the after effects of the strikes and kind of pullback by tech tenants. So again, it's just going to take time.
All right, so that's office. We get that out of the way. In New York, my personal metric for New York is when a building on 3rd Avenue trades. A big office building on 3rd Avenue trades, what's the discount going to be? 20%, 30%, 50%, 60%? I don't know what that number is, but that'll be the clearing thing for me. How about the rest of commercial real estate? Where do you guys see the best opportunity these days?
So from an asset class perspective, as we look forward, multifamily we think has a lot of positive fundamentals. Right now, multifamily is enduring a supply wave, but as you look forward over the next 3 to 4 years, you essentially have new supply for multifamily falling off about 50%, depending on which market you're in. So it really sets the stage for positive rent growth across the board, which we think is a really interesting play, especially as you have home ownership affordability continuing to be a real challenge. It really underpins the rentership demand.
So how does the Fed and rate cuts play into this when you think about CRE transaction activity? Because there was that indication that people were thinking rate cuts would be even more steeper, say, over the next year, but that's changed a little bit on the back of the election and the trajectory of that.
So the Fed rate cuts, it's a major milestone that we're on the other side of the restrictive cycle into the easing cycle. And so that actually has instilled a fair amount of confidence into the commercial real estate industry. You've seen a stabilization of transaction activity volume. You've seen a stabilization from a pricing perspective. So after things really fell off a cliff in 2023, 2024, there are some bright spots. And you did see in the third quarter transactions being able to get done with accretive leverage. Since the last couple of months have occurred and the rate trajectory path is a little bit less uncertain, obviously it's going to take time to play out for people to really grasp what that means for real estate economics. But overall, I would say the incremental easing that's anticipated is a big positive for commercial real estate.
All right, let's say I've got an idea for a great multifamily or multi-whatever kind of unit thing, and I want to go build it in my local town. Is my bank going to finance me? Can I get financing for real estate these days?
So there's been a huge shift in the financing landscape because banks have had to pull back very significantly. You've seen bank loan origination volume drop 26% year over year, which creates a tremendous opportunity for private capital. We're active in the lending space and we finance multifamily development, for example. So in our view—
What do you guys know about lending money? I'm the one who went through the Chase Manhattan Bank credit training program. You guys are like real estate people. What do you know about lending money?
We've been a very active direct lender
Really?
for decades, in addition to what we do on the equity investment side. And so there's, we think, kind of a permanent shift and opportunity for private capital because the banks have to reduce their commercial real estate exposure. And regional banks, of course, currently have about 30% exposure, which is way too high.
Interesting.
So how do tax policies fit into this?
So you can expect, obviously, Trump's policies to be generally very favorable for commercial real estate, given his background. He's proposed, of course, an extension of the 2017 tax cuts and additional tax cuts. You would expect that he preserves real estate tax benefits like 1031 exchanges, which is quite positive for the industry. But overall, tax cuts are stimulative from an economic growth and consumption perspective. And when you have a stimulated economy, that's generally good for real estate fundamentals.
So then on the flip side of that, what about trade policies as far as those impacting supply constraints?
The trade policies that he proposed, inputting 10% tariffs on all imports and 60% tariffs on Chinese imports, that could have an inflationary impact, driving up material costs, which on balance would be negative for commercial real estate. Obviously, if the cost to construct buildings is higher, that's a challenge. And if you have an inflationary backdrop as well, that potentially sets the Fed on a different path. And higher interest rates are not great for commercial real estate. So it'll be interesting to see these play out.
What markets are you guys most interested in these days? Have you been focusing on any individual regions of the country, or?
We're very active across the Sun Belt and coastal markets, but we dial up and down our activities depending on what's happening in given cities. So obviously, post-COVID, certain markets within the West Coast have been very effective. So we've been watching to see and waiting for the rebound there. But within the Sun Belt, where you've had significant job growth and demand drivers, we've been quite active.
Are there any particular cities that stand out to you in recent years, whether ones that are strengthening versus other ones that are still having issues here?
I would say, at the top of the list, San Francisco has been obviously kind of the poster child for the distress this cycle. Yeah. And we continue to see throughout San Francisco and certainly downtown Los Angeles, obviously, the incredible distressed office trades. And it's not just office, because you've had, the exit of the employment base from those areas. It's also affecting hotel assets. It's affecting multifamily rents and vacancies. It's broadly affecting commercial real estate negatively. So we're looking out for essentially the resurgence of those areas to be able to reinvest.
Student housing. Do you guys have exposure there? Because we had a guest come in a couple of days ago they were really focusing on student housing.
We are active in student housing. And that continues to be an area of strength, actually. So you've seen across the top tier universities incredible rent growth within the student housing space because primarily the supply has been quite restricted and the university enrollments have been growing. So that's been a bright spot. You've seen a lot more institutional investors interested in the space.
Mm-hmm. And whenever you're speaking with either different clients, what are they telling you right now? What are some of either the positives versus some of the negatives they feel like when they're looking maybe more broadly about the economy?
In terms of, I would say, investor clients right now, yield is incredibly important. So there's been a lot of interest in investors who historically had invested only in the equity side to now pursue real estate debt strategies because yields are, 2 and 3 times more attractive than they were back in the zero interest rate environment. So when you have the opportunity to earn equity-like returns on debt, that's something that gets people's attention. And then I would also say investors from an equity perspective are, starting to poke their heads back up based on the interest rate easing path and thinking about how they can be deploying capital at risk from an equity perspective in the future.
So are you guys in the market for capital right now, or are you in a fundraising mode now?
We're generally,
I think
actively,
you guys are always into fundraising. People in private equities and private credit.
We're actively pursuing new strategies, yes.
Actively pursuing new strategies. Okay. Can you answer the question, why do we have a housing shortage in this country? How did that happen?
So it's estimated, round numbers, about 4 million units short for U.S. housing.
The population's not growing that much. What's going on? Where did all these units, where did they go?
Well, I guess how much of that had to do with like post-housing crisis versus it getting exacerbated by the pandemic? Because it seems like there was already an issue and then it just blew up because of COVID too.
It's been an extended issue post-GFC. Essentially, you had a dramatic drop-off in the ability to get housing developed and financed. So we've been in a structural undersupply kind of regime ever since the GFC. And there's very little that's kind of changing in the outlook to correct that.
Right. What would need to happen to fix that realistically?
You need the economics of developing new housing to be highly profitable. And that will incentivize developers and capital providers to jump in a more meaningful way. And you saw that over the last few years with the zero interest rate environment, but essentially that supply pipeline has fallen off a cliff. Basically starting in the second half of 2022, new starts really plummeted because economically in a high rate environment, it just stopped making sense.
Robin, thank you so much for joining us. Really appreciate it. Robin Potts, she's the CIO, Canyon Partners Real Estate, based in Los Angeles, but stopping by our Bloomberg Interactive Broker studio here in Midtown Manhattan.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.